Yes, I'm a broken record. Please stay cautious, in my opinion. The stock market is in the midst of a bear market rally that will only turn into a bull market when quantitative tightening stops. Behind me on the screen, you can see that we have the Federal Reserve balance sheet. It has gone from a little under 900 billion to 8.9 trillion over 14 years, a tenfold increase. It has moved down 2.3% since April, which was the peak. This is barely a drop in the bucket after going up over tenfold. So quantitative tightening has just begun, and we have a long way to go in that process. The real question will be, when does quantitative tightening end, and what causes the Federal Reserve to blink? I think you need to wait on those two items before you get more constructive on stocks in general. It does not mean that individual stocks are not attractive, as some things have come down dramatically, and you need to pick and choose carefully. But in general, I would continue to keep a nice cash reserve. So that's my broken record. Stay cautious. I have more details about this information in a written report. As you can click through to the link below under the description, and you can also take a look at this as I go through it in detail. The first is we have had a huge increase in the Fed funds rate. It's unprecedented in the speed. The unfortunate problem is that the base that we started at was so low that we are still at a level that is really not restrictive. So even though we've gone to 3.25 from 0, and that's a huge increase, you can see on this chart here that historically the federal funds rate has been above CPI. We're currently at a situation where the Fed funds rate is way below CPI. And you really can't say that we are in a tight monetary policy as far as rates go until Fed funds rate is above CPI. So from my perspective, we're still in an easy environment with regard to this. We continue to believe that over time, what's going to really drive matters is the quantitative tightening, and that's why we have focused on the Federal Reserve balance sheet. After peaking in April at 8.9 trillion, we're down 2.3%. This is up greatly over the past 13 years. We went from a little under 900 billion to 8.9 trillion, a tenfold increase. That is very dramatic. And we basically have had a very nick at the huge bloated balance sheet that we have built, first with the financial crisis and then with the COVID crisis. So we are in unprecedented levels as far as how big quantitative easing got. It's an experiment that, quite frankly, has never been conducted before here in the United States. And now we are starting to try to roll out the second experiment of quantitative tightening, which is reducing the size of this very bloated balance sheet. To put this in perspective, we're down 2.3% from the peak. As I mentioned, we've gone up tenfold from the trough 13 years ago, before the financial crisis. So we have seen, very, very modest downturn, and it's already started to have an impact on various items. Interest rates have shot up here over the near term as the Fed has stopped buying Treasury bonds and actually started to let their balance sheet roll off a little bit. You've already seen a major price disruption in fixed income rates, as you can see on these charts below. The other thing to keep in mind is as rates go up and the federal government, which is running huge deficits, the current deficit is down to 1.38 trillion for the year ending September 2022. That is down dramatically from what we were the year before, when we had a lot of COVID stimulus taking place and lower tax receipts. But that's a deficit that's still very large, and will continue to have additional bonds issued. You can see here that the U.S. debt has run up considerably. From 1980, we're about $1 trillion in debt, and now we've broken 31 trillion, and we're clearly on the way to adding to that at about $1 trillion to $1.5 trillion a year. Now the problem is, as the Fed has let interest rates go up on both the short and the long end, as we roll these bonds over and refinance, we are going to have to be paying a higher and higher interest rate, the government is, higher and higher interest rate on these debts, and we're going to, that's negative for the deficit. So the deficit is going to expand from interest expenses with or without doing any additional things as far as military spending, social spending, increased tax receipts. This is all going to be, overwhelmed by higher interest expense, and so the deficit is going to expand from these levels from interest rates alone. And that expansion is going to cause a compounding effect on the national debt. And so we're going to compound the debt at a higher rate. And we're going to end up with a debt that is currently a little over $30 trillion, but clearly cannot ever be paid down. And so we're in a situation where the federal government's deficits and debt are clearly out of control, and there's really no way to rein those in. The other caveat is the federal debt, as shown here, at a little over $30 trillion, is only part of the federal obligations. We have huge, Social Security and Medicare unfunded liabilities that each are in excess of $30 trillion each. So total debt is a multitude of the U.S. economy when you're taking into account the federal obligations only. So we have a federal government that's basically spent beyond its capabilities for years, and we now have a debt and deficits that's spinning out of control. We think this will continue to push interest rates higher. When you take a look at where we are in the interest rate cycle, historically we have been at a rate that is very close to nominal GDP. Nominal GDP, given inflation so high right now, is running around 7%, and the 10 and 30-year Treasury are closer to 4% currently. So we still have room to go up to get to market-based pricing. As the Fed stops buying bonds and lets their balance sheet reduce, we would think interest rates would continue to go up even from these levels after having already surged. The other thing I want you to take a look at quickly is the tight correlation between the stock market recovery from 2009 to the Federal Reserve balance sheet. So if you take a look at this picture, you can see we started around $800 billion balance sheet, and then we surged up to this 8.9 trillion, and at the same time stocks bottomed a little later. The stocks bottomed in March of 2009 at 666 on the S&P 500, and then have had a huge recovery. But you can see this is tightly correlated. So if the Fed is really intent on bringing down their bloated balance sheet by the estimated $1 trillion a year, that would anticipate a continued decline in stocks. As liquidity comes out of the system, interest rates go up, stocks would all likelihood go down. We continue to think that caution is warranted, as this is going to take a while to resolve itself. I mean, the Fed has had the rhetoric about trying to fix the inflation problem. They were first saying inflation was transitory. Then they were saying, well, it's supply-driven inflation. But if you can see here on this chart, the inflation is a little bit on the supply side, a little bit on the demand side, and then an additional element that people really can't quantify where the inflation is coming from. Well, monetary theory would indicate that inflation is coming from the inflated Federal Reserve balance sheet as we went from a little under 900 billion to 8.9 trillion, and that is the primary cause of inflation. So if we're going to get inflation under control, we're going to have to continue to reduce the balance sheet aggressively. We should also continue to raise short-term interest rates and get short-term interest rates above the inflation rate for it actually to be in a inflation fighting mode. Now the bottom line here is that the pain that could be associated with these maneuvers of shrinking the balance sheet, quantitative tightening, raising interest rates, could easily push the economy into a deep recession. Unemployment would probably shoot up, and in our opinion, this would at some point cause the Fed to blink. I don't think the Fed is going to blink in the near term. Right now, employment levels are healthy. I don't think the Fed really is concerned about where stocks are. Stocks are still above where they were, in early 2000 before the COVID crisis. So stocks are really not come down that much. We had a big bubble that they inflated into, but we still have some room to come down before I think the Fed would start to worry about stock market levels. And quite frankly, stock market reductions hit wealth of a very concentrated group of people. And so that is not something that the Fed is really going to be worried about, and it will take some of the inflation pressure, off. So we don't think that the Fed is going to blink until something breaks. There's multiple things that are going to break. Clearly the one that is front and center is you begin to have to question the United States credit quality and what's going to be done to make their payments as their balance sheet and deficit spins out of control. And I think at some point the Fed is going to recognize that there's no way to control inflation without completely breaking the economy, and they're going to turn back and reinstitute quantitative easing. When that occurs is anybody's guess. This is going to be dependent on the speed of the employment strength deteriorating. I don't think we're going to tighten until we get really a lot weaker on the employment side. You're beginning to see some cutbacks here and there, but employment in general is still relatively strong. And I think we're way away from the Fed actually ending quantitative tightening and pivoting again to quantitative easing. So stay cautious. Please take a look at our website, buildingbenjamins.com, where you can sign up to get this information in a very quick fashion. You can also take a look at our full disclaimer where we talk about this is what I'm doing for my personal portfolio. I have more cash than normal, and I continue to do so. I do think this is a bear market rally, which will eventually peter out and will only end when quantitative tightening is dead. Thanks again. This is Benjamin C. Halliburton, and I hope you have a great day. Good luck.